All right, let's jump right in. We all face this huge question when it comes to our money, right? How do you actually grow it without that constant fear of losing everything? Well, today we're going to break down a really powerful strategy that tries to do just that. Give you that upside potential, but with some serious protection on the downside. I mean, this is the big one, isn't it? You see the market going up and you think, I want a piece of that. But then you remember, markets can also go down. And that thought of a major crash just wiping out years of hard work, it's terrifying. So the real question is, can you get those gains without taking on all that risk? And that right there, that's what we call the saver's dilemma. It's like this constant tug of war, you know? On one end of the rope, you've got this desire for growth, and on the other, this deep need for safety. Let's really look at what that choice usually feels like. Okay, so on one side, you've got the go-for-it approach, seeking growth. You jump into the market, you ride the waves, the ups and downs, all for the shot at those much higher returns. But then, on the other side, you've got the play-it-safe route. You keep your money tucked away, nice and secure, but you're kind of just watching from the sidelines. Inflation is slowly eating away at its value, and you're for sure missing out on those big growth opportunities. It really feels like an either-or situation, doesn't it? But what if that's a false choice? What if you didn't have to pick one or the other? Let's dig into a totally different approach, one that really tries to give you the best of both. So picture this. What if you could link your money's growth to a big market index? So you're moving when it moves up, but, and this is the game changer, you never lose your money just because the market has a bad year. Sounds a little too good to be true, right? Well, let's actually unpack how something like this could work. Okay, to make this super clear, let's use a simple analogy. It'll really help you see how this safety net actually functions. Okay, so just imagine your money is a climber, and the mountain they're climbing, that's the market index. Pretty simple, right? The whole goal is to climb higher and higher. So when the market has a good year, when that index goes up, our climber goes up with it. They're making their way up the mountain, gaining altitude. That upward momentum in the market directly translates to your value growing. Make sense so far? Now, nothing is totally free, right? In exchange for all this safety, there's a trade-off. It's called a cap rate. You can think of it like a ceiling on how high our climber can go in any single year. So even if the market absolutely skyrockets, say 20%, your gain for that year might be capped at something like 12%. This little trade-off, this cap, is what makes the whole downside protection possible. But this is the big one. What happens when the market falls? Because we all know it does. What happens to our climber when things go south? The answer is 0. That's it. A nice round 0%. You don't gain, but you don't lose a single dime because of the market drop. That's the floor. That's the protection. And this is where the magic happens. A safety net just appears. Our climber doesn't fall backward, not an inch. They just hang out right where they were at the start of the year. Their value is totally locked in, safe from the fall. The absolute worst-case scenario for them in a bad market year is 0. No losses. Okay, so the climber analogy is great, but let's look at some real numbers. Let's walk through a quick hypothetical 2-year example to see how this all plays out in practice. All right, let's say in year 1, the market is on fire. It goes up a whopping 20%. Awesome. But then year 2 comes along, and a correction. The market drops 10%. A pretty typical up and down scenario, right? So how does your account look? In that first year, when the market jumped 20%, you get credited, let's say, 12%. That's our cap rate doing its thing. You get a really solid piece of that growth. But then in year 2, when the market tanks by 10%, what do you get? 0. Your safety net deployed perfectly. You didn't feel that loss at all. And that's the bottom line right there. You get to capture a big portion of the market's gains, but you are completely 100% protected from the losses. It's the best of both worlds. So this isn't just some neat little trick. This power of protection can actually have a huge impact on your long-term financial picture. Let's zoom out and see why this is such a big deal. Okay, so what does this all add up to? Well, you get to participate in those market gains. We've seen that. Your money is also protected from any market downturns. That's the 0% floor. But here's another huge piece of the puzzle. Your cash value grows tax deferred. Think about that. You're not getting hit with taxes on the growth every year, which lets your money compound way more powerfully. And down the road, this can become a source of supplemental income that you can often access tax-free. This really says it all. The point isn't to try and beat the market every single year. It's about finding a smarter, more stable way to grow your money for the long haul. It's about avoiding those huge losses that can just completely wreck your financial plans.
So I just want to leave you with a thought. Ask yourself this. If you could completely remove the fear of losing money in a market crash, how would that change the way you think about your future? How could having that balance of growth and protection give you the confidence to really plan for the life you want? Something to think about. Thanks so much for joining me.